Hey there, realtors and clients. I was asked to do this video about a loan comparison and a cost of waiting based on a house that just went under contract here in Los Angeles, California. Home up in Altadena, actually, which is right outside of Pasadena and kind of up the street from downtown LA proper. Really, really beautiful, kind of quaint house. Pretty special place. Really nicely redone. I happen to know the listing agent, and I happen to have four mortgage clients who made an offer on this same house. And what's unique about this house is that of the clients, the four clients that I had who made an offer, nobody got their offer accepted because it is kind of a special lot, a special setup. And although it's kind of a smaller house by some standards, the price went well over $1 million. As you can see from Redfin, the house is under contract. I don't have any insider knowledge as to what the property sold for, but based on some feedback I got from the agents I work with, the listing agent, the offer that my clients made that didn't get accepted, I believe it went under contract somewhere around $1.2 million. $1.2 million. And for a house listed, a 2-bedroom, 1-bath at 1,300 square feet, a house listed at $899 and selling for $1.2 million. So, a huge premium, $300,000 above the asking price or the list price is pretty crazy, right? And I don't know for sure that it's going to close at $1.2 million. We'll see in about a month what the house actually closes at. But, when clients or realtors see this, it's really easy to get discouraged and say like, we're never going to be able to buy a house. There's no way I would pay $2 million for this house. The market is crazy. All the negativity starts to creep in. And I want to show you a little bit of what's called a cost of waiting calculator. So this is something we can do. I like to do it kind of just a general overall thought process because it doesn't really make sense to do this on each individual one-off property since we don't necessarily know what something's going to sell for. But let's look at this property. So we'll label this the Altadena property. And let's assume that the property sells for $1.2 million. Might sell a little bit lower, might sell a little bit higher. And actually, taxes in this area are a bit higher because it's Los Angeles and everything's more expensive in Los Angeles County. So we'll put in the appropriate tax rate of 1.25%. Use my rate. This monthly home insurance, luckily we don't have floods and hurricanes and tornadoes in California, and earthquake insurance is a specific type of insurance that a lot of consumers don't get. So we're going to put the insurance in here a little bit cheaper just because I happen to know more or less what this costs. There is no monthly association dues. And for the simplification of this kind of scenario, let's just assume that on the taxes of the individuals making an offer on this house, they use the standard deductions. Now, chances are they don't use the standard deduction. Chances are that they actually will get more benefit from being a homeowner because they'll get to write off the mortgage interest and the property taxes above and beyond their additional deductions that they have for being a business owner. But just for simplicity, let's say we're going to make the standard deduction here. And let's be honest, if you're buying $1 million home, you're probably somewhere up here in the 30-ish% tax bracket. You're probably making somewhere north of $150,000 or $160,000. So this is, most of my clients are going to be in somewhere here in this 32% range. And if you're buying in California, you actually have a higher tax bracket because you also have California state taxes. So if you can afford $1 million house, probably about 35% of your income, one way or another, is going towards federal and state taxes. Might even be higher than this, but again, let's kind of use all of the best case scenario for the consumer and worst case scenario for the market to see if this makes sense to buy this house at $1.2 million or just kind of give up and keep renting. So if we continue the exercise here, let's say the new loan is a 10% down fixed, right? So let's say, for example, the client at $900,000 thought they were going to be able to put 20% down. Now at $1.2 million, they're like, we can really only afford to put 10% down and we want to leave some money in the bank. So we're going to go ahead and do a 10% down loan. This interest rate of 4.75 seems about right. And on most jumbo loans these days, they actually don't have mortgage insurance. And we'll say your closing costs from the lender and what have you, prepaid interest, taxes, insurance, title, escrow. Let's say this runs you at about $10,000, okay? So by the time you pay for all the third-party entities, the inspections and whatnot, you're going to get about $10,000 in closing costs here in California. So we've got the loan, we've got 0 points, we've got this Altadena property, so we can calculate this. Altadena, here's the monthly cost for everything, which is cool. So this shows principal, interest, your all of your costs here, taxes. Is that about right? Yep, that's about right. That's right. Okay, cool. We got this. All right, we got all the payments. Now let's look at the cost of waiting, right? So this takes in a couple assumptions. It takes in kind of some analysis of the overall market of what's going on as far as where you are looking appreciation to go, the tax write-off, things of that nature. So what this shows is that, if you took the loan today, you did $1.2 million, you did your 10% down, property values are going up in this very hot Southern California property by about 7% a year. 6 to 7% a year. And look, I know there will be a lot of people out there saying, no, we're due for a market correction and there's a recession and there's going to be a massive collapse of property values and whatnot. I'll tell you, like the research that I've seen, it just doesn't support that thesis for 3 reasons. One, and I don't care which side of the political aisle you're on, Trump, Biden, doesn't matter. Both parties just printed during COVID about 40% of all of the dollars in circulation. So all the US dollars that are in circulation right now in America, about 40% of those were printed in the last 2.5 years as a response to COVID, stimulus. And so that's leading to inflation, right? The simple definition of inflation is too many dollars chasing too few goods. And guess what? In Southern California, they're not building a whole lot of new houses. There's a lot of inflation. Wages are up. And there's a lot of young couples looking for houses. So number one is just the simple inflation metric, right? Things are just getting more expensive because we printed more money. Number two, Gen Y, Gen X, Gen Z, millennials, these generations, like last 4 to 5 generations, are waiting longer and later into life to do the big life milestone things, buy a house, have children, get married. So there is a glut of home buyers that are looking to buy, right? So if we go back to our simple high school or early college economics, the supply and demand curve, there's too little supply, way too much demand, and that's causing prices to continue to go up, right? And then number 3, even if we are due for a recession, like a stock market recession, a correction, real wages are still through the roof right now because of the fact that a lot of workers have not returned to the workplace post-COVID. So, whether it's a lawyer at Netflix who I'm talking to who's making more money than she ever thought possible when she got out of law school, or whether it's a third-party graphic designs person who I'm working with who does, designs for Disney and video games and whatnot, they're making more money than they ever thought possible when they got out of design school. So the reality is the formation of families, the inflation, the real wages, the fact that property tends to do pretty well in a recession, these things all lead me to believe that these calculations are correct. So if we just look at, all right, yeah, it sucks. I get it. It sucks spending $1.2 million versus $900,000, especially when that's what it showed the property might be listed or sold for. It's really horrible to go from $900,000 to $1.2 million. I get that. But the cost of waiting, right? When we look at where's property going to be in 6 months, in a year, in 2 years, in 3 years, what's the tax savings that you're missing out on by being a homeowner versus a renter, right? You start looking at this cost of waiting, it's brutal. It's just absolutely brutal. So you're actually losing over 6 months, a year, 2 years, 3 years. You're actually losing tens of thousands and then hundreds of thousands of dollars by waiting to get into a property and continuing to rent. Now, obviously, your monthly payment is a bit higher now on owning $1.2 million property versus what you might be paying for rent. But when you think about the appreciation, the amortization that you're paying down, because this is a 30-year fixed mortgage, so you're paying down the principal. When you think about the tax benefit of being a homeowner versus a renter, you start to look at over 3 years, it's going to cost you about $270,000 more to buy a house in 3 years, and the cost of waiting versus what you paid down in principal, what you gained in appreciation, what you gained in tax savings, you're basically flushing $250,000 down the toilet over the next 3 years by being a home renter instead of a home owner. So I know it's tough out there, all. I know it's really, really tough out there. And we start to think about, well, should we save more money? Should we wait? Should we wait for a market correction? The reality is down here, cost of waiting, it's going to cost you another $5,000 to get into this same house in 6 months. Then it's going to cost you $10,000 more, $15,000 more, $20,000 more. Rates could continue to go up, right? So if rates go up, you're going to feel great about locking in a mortgage today. If rates go down, you can refinance, right? And you can take advantage of those lower mortgage rates. So just really important stuff here as far as the cost of waiting that, I've had clients sitting around since the middle of 2014-15 when the market had started to recover and we were seeing property values go up in California dramatically. And they're like, well, I'm just going to wait for a correction. I'm just going to wait for a market correction. It's like, well, that's not really how it's played out over the last 7 to 10 years. And if you sat on the sideline, especially in Southern California, on properties like this that you could have bought for $400,000 or $500,000 7 or 8 years ago, you've lost out on almost $1 million of appreciation, tax savings, and paying down your mortgage. So, they always say the best time to plant a tree was yesterday. The second best time to plant a tree is today. And that's the same thing with real estate, right? It's not trying to figure out the timing, buying, selling, when is the market going to collapse. It's buy real estate and hold. Don't hold off on buying real estate. I hope this cost of waiting calculator has helped.